house, or she at least has the right to live there indefinitely. Making sure that you bring someone in to solve these legal issues can often prevent the sale from imploding on itself. So remember, inherited property transactions are different because you are often navigating grief, family history, and money all at the same time. So give these clients extra time. Don't rush them. A family that feels supported by you, by the realtor, is going to become a long-term referral source. And ultimately, it's what we all want. We want that repeat referral business. So, okay, I'm not going to step on Chris too much here because I know he's going to cover this at length and he does a much better job. Um, but I'm just going to touch on it for a minute. So, step up in basis. Most of you probably already know the basics of step up in basis, which basically just means that the taxable basis resets to the fair market value of the house on the date of death of the homeowner. And this is where inherited property becomes very different from a standard sale. The big takeaway for you is that decisions made before the sale can dramatically affect capital gains taxes. Changing ownership incorrectly or misunderstanding trust terms can accidentally create tax problems. So, again, this is why inherited property is one of those situations where a realtor can really add value by encouraging clients to involve a CPA and an estate planning attorney early before anything is transferred or listed. Okay. All right, so now let's talk about some of the common mistakes made by families regarding real estate. Often they're trying to do the right thing, but they simply don't understand the legal process. There are four mistakes that we see most often in our practice, and you probably have seen these as well. Number one, adding their children to the title, thinking they're going to avoid probate. We touched on this in the last slide, but it might avoid probate, but it's most likely going to create gift tax issues and trigger property reassessments and can expose the property to the child's creditors or even divorce proceedings. So we really recommend that if you get to it first, do not encourage them to add their children to the title. Number two, selling before legal authority is clear. We've talked about this a lot, but remember, if they don't have the legal authority to sign, the sale can be voided and you could be held liable as well as others. So be really careful there. Outdated or unfunded trusts, especially trusts that are old, a trust that was written 20 years ago, or one where the property was never titled, it may not protect the estate at all. So old trusts, and I see this all the time, have often been restated and they have a completely different document, but they never mark the old trust as being revoked. And so the seller might be trying to use a revoked version. They might have an old version that was revoked and they're holding on to that, trying to use that and pretending like the new one doesn't exist. Be careful. Ask if it's the latest version. Keep track of your conversations to protect yourself. You don't have a legal right to see the entire trust, so you have to rely on them, but you have to ask the question. Make sure you ask, is this the most recent version of the trust? And document the date and time and the answer that they gave you. So if it ever comes out that you weren't working with the right one, at least you can have some protection. Okay. And then finally, a common mistake is assuming that all the heirs are going to agree. Never assume this. One dissenting heir can block a sale. They can demand a different price or they can force the transaction back into court. So when you recognize one or more of these things are happening, again, it's your signal to recommend an estate attorney and or a CPA immediately. Okay. I see this happen all the time and it completely derails a sale and it's not something you want to get involved in. So, okay, when do you call an estate attorney? We've covered a lot. Let's start to summarize. Remember, the earlier professionals are brought in, the easier your job's going to be, and the smoother the transaction is going to be. Okay, this slide's going to list all the times when you want to bring in an estate attorney. It may not be inclusive, but it's a good start. All right, so death of an owner, anytime a property owner has died, authority to sell must be legally established. Okay, incapacity, a seller who can no longer make decisions. They're going to need a valid power of attorney or conservatorship in place before sale. Again, remember, those things are only valid while they are alive, but they do have a very, very good place when that person is alive but incapacitated. Family disputes, if heirs are disagreeing, Price, timing, terms, bring in a lawyer before it escalates. Unclear trust language, sometimes, not me, but there are lawyers out there who sometimes write trusts who are not well written, and you need to make sure that the trust document is not ambiguous about authority or distribution. Okay, legal review can be essential at that point. And then finally, questions about authority. We've talked about that a lot. If you're ever uncertain whether the person you're working with can legally sign, stop and verify. Remember, the goal is not to hand off your client to a CPA or an attorney, but it's to build a team around them. Realtors, CPAs, attorneys, and escrow working together, that's the gold standard, and you want to be a part of that. Okay, so here's your opportunity, right? Each of these issues that we've discussed presents a golden opportunity for you to stand out from the crowd. Most realtors don't understand trusts. They don't understand probate and they don't understand inherited property. So the ones who do become the go-to resources for families and attorneys long term. And that's, again, what we're all looking for. Your clients are going to remember your calm guidance and your referrals to qualified professionals. When you stay composed and you know who to call, families are going to trust you completely, and they're going to refer to you for years. What's more, professional partnerships help you grow your business. Estate attorneys, CPAs, and financial planners who trust you will send referrals to your way consistently. It's a mind shift. The most successful realtors in complex situations aren't the ones who know all the answers. I know we like to think we do, but they're not the ones that know all the answers. They're the ones who know the right questions to ask and the ones who know the right people to call. That's when you're going to be the most valuable. So the key takeaways, I've said a lot, but if you hear nothing else, remember the best transactions are completed when realtors, CPAs, and escrow and estate attorneys work together before the problems arise. Okay, ask questions early, verify authority, bring professionals in. Inherited property is different. Those are the 4 things that you need to remember. Okay, ask the questions before the listing, not after the issues arise. Don't assume the person you're working with can legally sign. Bringing professionals in the beginning rather than later. And be sure you recognize that inherited property is different and needs to be treated with extra care. So I think we are at the end. Thank you so much for your time. We do have one more speaker for you, and then we'll be happy to take your questions. If you don't get your questions answered today, I'm happy to answer them in a call, one-to-one at a later date. You can click on the link there for my contact information. Email me, and I'll send you a link to my calendar. And I'll be happy to give you some time offside. So now let me introduce the next speaker. So realtors know that one of the fastest ways to lose a deal or lose a client's trust is when someone gets blindsided by taxes they never saw coming. Capital gains, inherited property issues, primary residence exclusions, investment properties. These are the kinds of questions that your clients are asking every day. But fortunately, the next speaker is not your typical CPA. He has a way of making complicated tax and real estate issues actually interesting, understandable, and most importantly, practical for real-world transactions. I think you're going to walk away with some information that will genuinely help you better serve your clients and protect their financial interests. So please welcome Chris Borg.
Thank you, Ramona. First of all, before we move on, I do want to say that I am a CPA and have been working with a lot of people kind of in this financial and wellness sphere. And attorneys, mortgage lenders, uh, those types of, retirement specialists, those kind of people, they're like flies or mosquitoes to the lights that is the CPA. There's just like hundreds of them, dozens of them all the time. And because of that, I've had to learn how to weed out ones that are just the typical ones and ones that could really truly help my clients and help the people that I work with. And I do want to say that Ramona has been historically a very good resource, not just for my clients, but other people that I've worked with have had nothing but great things to say about Ramona as an attorney, as an estate planner. And so if that is something that you run into that you need personally or that your clients may need eventually, I would not choose anyone else over her. She's definitely the best that there is.
Thanks.
And sometimes it's hard to give a presentation that is memorable on topics like tax and estates. And I think she did a phenomenal job. And it really reflects how she does things for her clients as well. So I just wanted to throw that out there. She's not just a stranger to me. I've worked with her many times before, and she's fantastic. Um, okay, now with that being said, let's go into the lesser than presentation, mine. Huh? So, like she said, I'm Chris. I'm a CPA, and I work with a lot of businesses and business owners. That's kind of historically been my cup of tea. But I also work with a lot of different people, individuals in retirement, people with real estate portfolios, all kinds of different areas. And I've interacted with quite a few people, which has led to me hearing a lot of questions and have also learned what the surprises most often are if people are not well educated and are not planning ahead. And so I wanted to kind of give a presentation to all of you that essentially is the basics that I would love for real estate individuals to know when they're facing with their clients before it gets to me so that my hard part of my job doesn't happen very often. Because the hardest part about my job as a CPA is tax surprises, people not knowing that a tax bill is coming. And real estate transactions not only can lead to a lot of surprises, but they can lead to very large surprises that they were not intending. So we hope that the hope is just like Ramona was doing in her presentation, that we give you a few things that you can use to make you look like a rock star, to make you look like a hero, or if anything, to know when it is time to refer out to a CPA or to an estate planning attorney. So, first one I want to talk about is capital gains on the primary residence. So there's a lot of little things that could go into calculating the capital gain that could arise from the sale of a home that is a primary residence. First of all, the big one that a lot of people understand is a concept but don't understand the subtle stuff about it is the exclusion on the gain from the primary residence, which is essentially $250,000 if you're single off of the capital gain, $500,000 if it's married, if they're married. And that capital gain exclusion for it to be considered a primary residence, the individuals need to have lived in the home for at least the last, or at least 2 of the last 5 years before the sale. That's a typical one that a lot of people throw out there, but they don't understand little things about it. Like, biggest example is it doesn't have to be the last 2 years of the five. They could have lived in it for a year, then rented it out for three, then lived in it again for a year, and that still qualifies. The other thing is a lot of people try to strategize of like having it be a rental, but then live in it and they get that exclusion. And that's totally cool. But something that if you hear your clients kind of talk about that or understand that that's part of what they're trying to do, one thing that you should make sure that they know is that even if they have more than enough of the exclusion once it comes off because it was considered a primary residence, there still could be depreciation recapture that adds to the total tax that they pay if it was a rental or was used as a home office purpose. A lot of people think that that recapture is also eaten away by the primary residence exclusion, which it's not. It comes after that's all been done. So that's something to keep in mind. Also, when if there's still money left over after the capital gain exclusion, or they don't qualify for the capital gain exclusion, you can let them know that any cost that went into the home can be used to offset the capital gain. We like to tell our clients to think of this primary residence just like any other investment that they have, whether it's a business or stock or whatever. You want that property that you hold on to appreciate in value or to retain its value. And in order to do that for a home, you got to take care of it. So sometimes that means putting paint on the walls. Sometimes that means fixing plumbing issues. Sometimes it means adding on another back house or improving the kitchen or new appliances, um, sweeping under the fridge, light bulbs being replaced. I mean, it could be as little as any of those little things. Um, Most of the closing costs are included, but there are some closing costs that can't be included in that, namely some of the taxes that they pay. But those are all things that even if it was 40 years ago, uh, and they replaced the HVAC system in like 1985 or whatever. Any of those costs can be added to the basis of the home to calculate the capital gain. The question that most often comes after I say all that is, am I going to have to pull out receipts? Like if your client bought the home in the 60s or 70s for like a bag of raspberries and now it's selling for $2.5 million. And back, 40 years ago, they replaced the hardwood flooring. The question is, do I need to have some kind of paperwork or proof that I did that? And as dumb as the IRS is, they're not stupid, and they understand that most people don't have receipts for that far back. So we always tell people our clients need to make it as official as possible, like they've been keeping a running total since the beginning. So in an Excel spreadsheet, really list out all the individual things with their associated costs that you're adding to the basis. And then for the last 5 to 10 years, if you can, bring out the receipts. Because if you got audited and they said, hey, where's your receipt from 1982? They understand that it's probably not going to be there. But if they ask for a receipt for 2015, that's more reasonable to maybe have that. So just keep that in mind when you're giving advice to your people. Also, most important note, a lot of clients think that the tax that they pay is based on the cash they're walking away with, which could not be farther from the truth. A lot of times people think, oh, I ended up paying my mortgage off with most of the money that I received for the sale, so the gain really won't be hardly very high at all. Money that they use to pay off the rest of their mortgage once the sale goes through does not go towards their capital gains and losses. It's not part of the calculation. Also, I won't have any taxable gain because I just turned around and used that money to buy my next house. That one is like a stab to the heart for me as a CPA because that means that most of the money they receive for this sale that could eventually have tax consequences might have turned around and been used to pay for their next house, which means they don't have the money to pay the capital gains or pay the tax that could come from it. So keep that in mind. And then, like I said, little tip for everybody, if the home was a rental property or they used a portion of that property for like a home office expense on their tax return, you could let them know that they have potentially some tax consequences from it, regardless of how much the exclusion might take away from the gain. So tip number two, capital gains on inherited property. Like Ramona said, we're going to talk pretty heavily about that. When someone inherits a property, the tax basis is reset to fair market value at the date of passing. That's what the technical definition of what that means, the step up in basis that we all hear about. That could potentially eliminate any of the capital gains or really mainly the previously built-in capital gains. So if a grandmother or great grandmother bought a house however many years ago for like 20 grand and then they passed and it pushed off the property to their grandchildren and it's worth $3 million, then they sell it for $3 million, no gain. Same thing in that same situation, but let's say the inherited or the people that inherited the property waited for a year and then it's worth 3.5 million. then the gain is only that difference between the value at the date of passing and when they sold. So it's a huge, huge benefit for people. Very important note. The date of passing is when the step up occurs. Let's say it one more time. The clients need to know that the date of passing is when the step up occurs. A lot of times we've heard, and I've personally been involved with horror stories, and I've heard of other horror stories where a person is on their deathbed or close to dying, and they decide to sign over the ownership of the property or the house to their son or to their grandchild. And in doing that, they want to make sure that they were able to see the transfer of the property and see their legacy and what they left. And as much as I respect that, as much as I love the idea of somebody wanting to be the one to transfer ownership, it could not be worse for them and better for the government if that was the situation. Because if that happens and it's not inherited but rather transferred of ownership, even if they passed 3 days later, technically speaking, that means that person that got the property inherited the property at the original basis when they purchased it, which means the government is having a heyday for how much they're going to get in tax revenue from that transaction. So let them know that if they want to do a transfer of ownership to the person, to not involve any paperwork, to not involve, just bring them into the room, have them give their speech and say this is going to happen, and then actually have the transaction happen when they pass so that nobody is paying the government more than they deserve. Um, doesn't matter where you land politically. I think we can all agree that they don't deserve a whole lot. So giving them more than they deserve is just a terrible idea. So stepped up basis is what they can use to calculate depreciation if they choose to rent out the property as well. So same thing if they decide not to sell right away, but rather rent out the property they inherited. It's at the stepped up basis value, not what they originally did. Also, very important tip for those of you who are in California, which is a community property state. If I passed, but my wife was still around and now she owns the property 100%, she gets the step up in basis for the entire thing, not just my half. That's not the case in every state, but it is the case in California. So if that spouse decided to go and sell the property and move into another house after their spouse passed, they would get the stepped up basis for the entire thing, not just their half. Okay, tip number three, the LLC. Ooh, this is a big one. I'm sure you guys have all heard about LLCs. Um, we're living in a world of social media and everybody is claiming to be an expert. And although there is some great tax advice being given on social media by people, there is also some really, really terrible tax advice being given. And one of the very popular ones that people are throwing out right now is getting an LLC, regardless of if it's for real estate or just business in general. Uh, Getting an LLC as a strategy to save on taxes has been thrown around quite a bit. And this is quite a controversial statement coming from a CPA, but LLCs are not a great way to save on taxes, especially for some of the reasons that they're throwing out on these like TikTok tax advisors, as I call them. LLCs are really meant to separate personal assets from property or business related risk. So if the person is trying to get an LLC to separate the LLC or the property that they invest in from their personal assets, liability wise, that's a great reason to get an LLC. What a lot of people are talking about is getting an LLC so that it's less likely to be audited and you can run a whole bunch of business expenses that maybe aren't even business expenses in there. You can start taking all your travel as long as you're going to visit the property or if you're going to a business symposium in Italy that happens on one day while you do the like 7.5 weeks in Italy, just tourism stuff, that you can take the whole thing as a business expense. And although I'm all for taking everything that you possibly can within the realms of the tax code to stick it to the man, I do encourage you to be careful with how much you advise people on that because like I said, the IRS, as dumb as they are not stupid and they're wising up to a lot of those things. So when it does make sense to get the LLC, if it's a rental or investment property that you're trying to separate from your personal assets, if there's multiple owners in the rental property, that's a huge reason to make sure that they get some legal and LLC asset separation. If they're trying to grow a very large real estate portfolio or they have higher liability exposure. When it doesn't make sense to get the LLC is if it's their primary residence. If your business, the LLC, like we said, is just to separate business and personal assets. And so it wouldn't make sense to put your personal asset in a business. Um, Also, this is one that's also kind of controversial, but a lot of lenders, as of right now, are not loving lending out money to LLCs. They are much preferring to lend out to individuals. And so that could cause some issues. And then also, if they have a really great insurance policy that already kind of covers all the or the risk or liability protection, then maybe an LLC is just overkill. Wouldn't hurt, but that also could be something that may not uh, be necessary. So here's some things to say if you run out of basics to talk about, right? So those are kind of a few of the basics that could come up. And if there's more questions, my suggestion, which is a good suggestion, is you could say something like you may want to consult with the CPA about potential capital gains and tax consequences before making it official. That's a good thing to say. An even better thing to say would be, I have a great CPA named Chris that would be more than happy to talk to you. I am more than happy to help anybody with potential tax consequences, especially ones that come from real estate advisors. That is a really great power partner for me in the sense that I don't want you to give real full-on tax advice. Just like I don't give people advice on whether it's time to buy or sell in the markets right now. That's like right over my head. Um, and so I let people know that I do complimentary consultations with new clients. And so if somebody came to me and said, I got referred to you by somebody, real estate, said that you could do a second set of eyes on my tax return or give you all the information on my sale of a home and wanting to calculate what could come as a gain, more than happy to do that for anybody. So yeah, like I said, that's kind of what I had planned. There's also a lot of other things that could come up with real estate stuff, a lot more than what landed in this kind of time frame that I have access to. So if you want to screenshot this or take a picture of that calendar link or the email, I'm more than happy to be a resource to you. And I appreciate the opportunity I've had to speak to you all today.
Thank you very much, both Christopher and Ramona. That was a lot of information, a lot of great information. Does anyone have any questions? We have a little bit of time here until the end. Does anybody have any questions or anything that they want to bring up? Bina, go ahead.
Hi, this question is actually for Chris. I'm curious, at the time of death, when we have that number that we look up as step up basis, what resource are we using? Do they come to us? Do they come to you? Do they go to the attorney?
Yeah, great question. Are you referring to like what do you use as the value at that time? Yeah, there's kind of a hierarchy of what I would use. The ultimate good one that happens pretty frequently when it comes to, sometimes it's just kind of naturally part of what happens at the time of death, which is an official appraisal. Sometimes people get an appraisal so that the heirs can understand what it is that is being split among them, official value. Like we all can agree that money does some strange things to people. So sometimes when it comes time to inherit and split things up, they do it really official and pay all the money to make sure everybody knows what they're getting so everybody is fair. That's probably the tippy top. The next one down, sometimes real estate agents can provide comps of similar properties in the neighborhood, in the area, similar homes that have sold for certain things. You can use that. As a last ditch effort, which happens more often than I would probably like to admit, but people come into my office and say, this home was inherited, they passed in this day, this year, and it sold this year, and that's all I have. And when that happens, I go to Zillow. I look it up on Zillow and I get a rough estimate with the mouse on that spot of Zillow where it has the graph of like the when and if things are going off. And I print a screenshot of that and I tell them that this is probably the worst number that I could possibly use, but it is more than just nothing, right?
My number is
Yeah,
do
yeah.
not go to Zillow. It's a dangerous, dangerous.
Yeah, so like I
So,
said, it is when people come to me, that's kind of the hierarchy that I tell them. But yeah, that's like if I'm having to calculate the thing. The other thing is normally when it comes to that, the capital gains are not very high. The exclusion kicks in. And so we just have it kind of as a thing in our file.
right.
But yeah, that's kind of where we go if that's like the last ditch effort of trying to have something as a piece of evidence that gives us that value at the time that they passed.
Okay. And all three sources are pretty much acceptable by IRS, I'm
Yeah,
assuming. Okay.
yeah.
Okay.
I mean, yeah, like I said, the IRS may say the same thing that everybody else in here is kind of saying is like Zillow's probably not the best of chances, but if they send an auditor and they're looking at the file and that's part of what I give them, and it is like the client did not have any other resources or ways to find the property, so that's what we found. We have had a couple instances where that's the case during an audit or a review, and it has gone off pretty smoothly. They're not really in the business of nitpicking things like that. They really are more looking for people who just like came up with a fictitious number. So having something in the tax file that says a number that matches what you put on the tax return is more than enough. Yeah.
Okay. All right. Sounds good. Sounds like you don't have a realtor you can call.
I mean, I have, like I said, there's so many people, but that historically has not been something where it's like I could direct you to somebody who could give you more than enough information on what the value of the home could be. Yeah, it could be something that I look
No.
into.
Okay. I'll send you my information.
Great.
As I will share your information with others. I actually do have someone right now that's in a situation. Father passed, home was in a trust, like 5 siblings. In the midst of all of that, one of the siblings passed away.
Oh.
And now this other sibling survivors want to sell. And the other half want to sell, half don't want to sell. And you know, money is brings out a different personality in
Yeah,
everybody.
does some strange things to people. That's what I always say, because that's kind of the catch-all of yeah, and the nice way of putting it. Yeah.
Yeah. Now they're trying to sell, but they're like, wait a minute, we have to probate this. We can't sell it. And I'm like, well, you need to
Yeah.
talk to somebody who knows better, not me. So hopefully I'll be able to get them to call you.
Yeah, I'm more than happy to help for sure. As
Sounds
is Ramona, I'm sure. Yeah, whenever anybody says probate, that's when I start calling Ramona. That's for
yeah.
sure.
Gonna stick in my head now.
Yeah.
Thank you.
Thank you, Vina. Thank you, Chris. We have another question that came in from Diana. She's asking who besides the client's CPA needs to know the value of the home at the time of death.
I mean, that's a good question. I'm not sure if I have anybody that comes to mind of like where officially who needs to know that. I mean, when it comes to calculating the capital gain, it's really the CPA so that he can put it in the tax return and know how to calculate the tax. But I also know that I'm not, that may be a question for Ramona, if that is anything that ever comes out when it comes to like divvying out the assets. It's very important that the number comes out of what the value is so that the fairness is spoken about. Um, Ramona, what are your thoughts on that? Is that something that is important to know?
Well,
Especially
yeah,
with
because they're going to want to know for sure how much profit they're going to get out of that house. So they want to know what that value is. Um, so definitely the client's attorney or the clients themselves, they're going to want to know the value at the time of death because um, also that's going to determine, like you said, the capital gains if they decide to hold on to the house. So they're going to want to know it was worth 800,000 when grandma died and we're going to hold on to it for a couple of years. We have to pay attention to how much capital gains that's going to cause. Yeah, so definitely the family is going to want to know that.
The other thing I'm thinking of is if a person passes, people inherit the property and they decide they want to rent it out, but there's a lot of work that needs to get done on the home before it's like rental worthy. So they
Hmm.
want to go get a loan, like a construction loan or a mortgage loan to help pay for some of these renovations that they could get. Um, that is definitely something that they're going to need to know is the value of the home. But I also know that in those situations, Zillow screenshots aren't, it's going to have to be a full appraisal. That's going to be something that's a requirement for them. Um, so that's the only other thing that comes to my mind when it comes to that. Um, but yeah, the capital gain is definitely up there as far as like why it's important to know what the value of the property is. Yeah.
So we
Another,
also had another question come in, and it was more of an example. So in this example, mom has a property in trust, and she wants to sell the property and buy a new property, and the son is the trustee. So is it okay to sell that property? Um,
um,
and what would the capital gain would increase? In do you,
Yeah,
I guess
well,
that
when do they? Yeah, nobody
yeah
knows that.
yeah
Yeah, if only we knew that. The son is the trustee. That sounds weird. Mom's probably the trustee now. Son is probably the trustee when mom dies. So,
gotcha.
if mom's dead already and son's the trustee, yeah, it's a little bit. Maybe Michael, if you want to tell us what the actual question is. But assuming mom's alive and the property's in a trust. Mom is probably the trustee and maybe son's co-trustee, but it's unusual for a live person to have someone else be the trustee. It can happen, but it's unusual. Um, and
Yeah,
yes, you can
she
absolutely sell a
must have
house that's in a
not told
trust.
me. Okay, she must not have told me correctly.
Yeah,
So
you can
she,
absolutely sell it. The trustee just obviously has to sign off on it, prove it. But like I said, if mom's actually the trustee, then son. I mean, you'd have to find. I don't know for
you have to
sure,
see the trust. Yeah,
but
I get it.
um,
All right.
yeah, and feel free to call me if you have if you need further direction on that. Feel
Okay.
free. And
I,
then
I
as
have
far as
another
when we,
crazy question for you guys. Mom and dad bought a second home. They did improvements. They moved the property from joint on title to a trust, and then they moved it to the LLC where the dad was the only owner of the LLC. Then changed title to the dad and son and got it out of the LLC. Well, what do we do with the capital gains and all that?
oh, that's a Chris question.
When it went to
That's a
the
hard one.
LLC, was it for the purpose of maybe potentially taking some depreciation on the property as like an investment property or a rental? Or was it just sitting there at like a just
Uh,
like a balance on the balance sheet
it
item
was a rental. So I
rental?
went from a second home into the trust. Then they made it a rental, so they put it in the LLC. And then the son refinanced it in the dad's and the son's name. And now it's joint tenants. So I think they had a value change when the son and the dad did the um refinance.
And the question is how to calculate if it's sold.
Correct.
Okay. It depends on when, if it sold, if like the rules still apply for like getting the exclusion off the gain if they lived in it for the last two of five or for two of the last 5 years.
What if only one of
Um,
them did?
That is an interesting question.
So that's give Chris a call.
Yeah, yeah. That's one
All
that
right.
it's like we're gonna have to like see all of the things and map it all out. I'm a very
Right.
visual guy. I have a lot of
Yeah, that
yellow
sounds like a definite
notepads that
map.
it's like, okay, when
Yeah,
did this happen? What year? How did it? Okay, who owns
For
it now?
sure. Yeah.
The main thing to know is that when it was a rental property, it most likely had depreciation coming, which means that it most likely will have tax consequences regardless of if they qualify for the exclusion or not, how to calculate that gain and how much is ordinary income versus capital gain income. That's definitely you should call Chris and schedule a time to meet with them so I can kind of map it all out. Yeah.
Okay. The other question I have, something totally different, is have you heard about collecting the depreciation on a rental property up front for 30 years for tax purposes?
So taking all of the depreciation
Yes.
like all at once, you mean? Like
Yes.
accelerating the depreciation?
Yes.
Yeah, I mean some people they try to um take the depreciation like bonus depreciation or section 179 like you would with like a piece of machinery or equipment and accelerate that to take it all at once. Um Whether that's allowed or not allowed, there's a lot of crazy rules that are associated with that. And 9 out of 10 times, even if you do qualify, I encourage people that it's probably not the best idea because then if they sell the property, it's like there is no basis. You took it all away with taking all of the depreciation all at once.
And are there
Um, but
consequences
in
if they
doing
sell it
that,
early?
if you did that and then you left it as a something to leave to your kids or heirs, and then they inherit the property and they get the step up in basis anyway, it could be potentially something that could be a good strategy. But in taking accelerated depreciation on a rental property or a property in general, it's very more commonly not able to happen than able to. Yeah. I mean,
Okay. And
there's
if
lots
they
of CPAs that could jerry rig the system and make it happen either way, but whether or not the IRS will like it is another story. Yeah.
understood, and if they sell it in 10 years versus the lifetime, 30 years, is it going
Yeah.
to be an issue?
I mean, the depreciation recapture, it happens either way. Yeah, regardless.
Okay. All
So
right.
it's like a separate, like I said with before, with if it's a property that they can claim the exclusion off the gain, the $500,000, and the gain was only 200,000, so they still have 300,000 left of the exclusion that they didn't use. None of that is even used when it comes to the income that adds from the recaptured depreciation. It's like a separate thing that you have to take either way. Yeah.
Okay. I appreciate you helping me understand that, but I do know that I am not a tax consultant, so I would have to refer that out to
Yeah.
Chris.
Yeah.
So
That, like I said, that's hopefully enough basics to kind of keep you going as long as it takes before you can say
that's enough for me to
that's
say
a
you got to
question for
call your
Chris. Yeah, let's
CPA.
get
Yeah.
Chris on the phone. Let's get
Yeah,
Ramona on the
absolutely.
phone. Yeah.
Okay.
Yeah.
Thank you.
Awesome. Thank you very much. Any other questions? I know Ramona has a hard stop here pretty shortly because she has another meeting that she has to get to. So if anybody has any questions for her before she hops off, and if not, thank you all very much. Thank you, especially Ramona and Christopher for giving us all this awesome information. Let's see, we have one more message. Oh, just everybody saying thank you. Yeah, so if you have any more questions, you have their contact information if you want to follow up with them at all. And if you didn't grab it or later down the road, just reach out to me and I will be happy to share their information with you. Again, thank you, Chris and Ramona. Very much appreciated.
Thanks for having us.
Yeah, absolutely.
Thank you very
So as a
much.
reminder, we put on these free trainings every third Wednesday of the month at 1 o'clock Pacific Coast time. Next month, we have a professional negotiator who's going to come on and teach us some important skills. So we hope that you will join us then. Thanks again, and everybody have a wonderful day.
Awesome.
Thank
Bye.
you.